Hello, thank you for joining us on this week's Market Carver. I am Andrew Thrasher, Portfolio Manager, joined by Zach Unger, Senior Analyst. We have two big topics to talk to you this week about. We're going to look at how the market responds to crises, and then we're going to start looking at the labor market and the impact of some of the immigration policies that are coming down the pipeline. But first, turning back to what's going on, I'm sure you've seen the headlines about what's happening in the Middle East. We have two major countries starting to attack each other with Israel and Iran, with a lot of other countries that are saying they possibly could get involved as things begin to escalate quickly. This isn't the first, unfortunately, time we've had really a major crisis, either internationally or something that could potentially draw the U.S. in. And so naturally, we start getting questions about what does the market do? Does the market care? Is it because it's not involving the U.S. right now? Does it kind of look past it? And so we want to kind of look at the data as always, not get caught up in the headlines or the emotions. We want to share the first facts coming from Ned Davis Research, where they went back to 1919. It looked at 56 different crises. And what they found looking at the Dow Jones Industrial Average is that typically when you have a crisis like this of different varieties, that the market responds on average by dropping 7%. But what's important to recognize is 6 months later, the market was actually higher by 9%. And 1 year later, it was up 15%. So we often do see the market begin to start looking forward beyond the crisis. Now we'll go to the next slide and kind of zoom in on this table. I know there's a lot going on there, and I don't expect you to be able to see or read every single line item here. But what this table shows is prior times we've had a crisis, whether it was an assassination attempt or resignation, oil embargo, Brexit, all different types of military actions going back to 1940 through last year. And what's important to recognize is we do see some red in that 1 month column. The market sometimes does have a negative initial response. But as we start going out in time, always wanting to keep that longer term perspective and outlook, is we start seeing a lot more green show up. In fact, the market was higher 65% of the time 3 months later, as well as 12 months later. And on average, 12 months later, it was up just on average 3%, and the median return 7%. And so while the market can have a negative reaction in the short term, when we start looking at things that are really material, the major market moves, it does begin to look forward through those periods into actual what companies' earnings are, into what the actual economic data says, in the different price changes that we're looking at, and we bring into our models and bring into our process to make the decisions that we do within the portfolios. So while we know the headlines that can be very dramatic and they can be very worrisome depending on what they are, we want to remember the market doesn't always take those into account. And when they do, it's often, most of the time, pretty much in the short term. And as always, we're watching the data, we're watching things closely, making changes and adjustments as we see fit. So now with that, going to shift over to Zach, who's going to bring it back home to the U.S., looking at the labor market.
Yeah, so immigration certainly has been a hot topic as of late, especially in the political sphere, but we wanted to take a quick look today through a more economic lens. The chart you're seeing on your screen here shows the change in foreign-born workers as a percentage of the total U.S. labor market, the total U.S. labor force, rather, goes back to the mid-2000s. What stands out most here, highlighted by that red arrow on the far right, is the sharp drop that we've seen over the past 2 months. It's actually the biggest back-to-back decline in this percentage since 2020. The decline here in foreign-born workers has contributed to a shrinking overall labor force in the U.S., which in turn helped keep the unemployment rate steady at 4.2%, even though the actual number of unemployed workers increased. It might seem counterintuitive at first that we can have an increase in the total number of unemployed, but a static unemployment rate. And that's actually because the labor force is shrinking faster than the number of unemployed is rising. So even though we have a higher number of unemployed nominally, the unemployment rate stays fairly steady. If this trend continues, this shrinking of foreign-born workers in the labor force, it is very possible that we could see an unemployment rate that's stable or even falling, even as the broader economy slows down. Simply because there are fewer people in the overall labor force. And that number of people in the labor force is a pretty significant input when we think about economic growth and GDP as a whole. At this point in the process, most economists aren't expecting this trend to spark recession or have broad, dramatic economic impact. But there are certainly implications for industries that depend more heavily on this part of the labor force. Thinking about industries like landscaping, construction, agriculture, meat processing, etc. It's estimated in these particular industries that foreign-born workers make up somewhere between 15 and 20% of the total labor force here. As that part of the labor force in those specific industries decreases, it tends to put pressure on overall productivity of those industries, not able to produce as much, supply is a bit constrained, and that can have implications for end consumer pricing. As always, with every policy decision, there are trade-offs, both positives and negatives. But moving forward, it's going to be very important for us to monitor not just the headline numbers that come through, like the unemployment rate, but also to take a look under the surface to gauge the context with which those numbers are coming out. So we'll continue to monitor this shift as it unfolds, this trend in the labor market as it plays out. But we're going to be pretty keen to analyze the context and what's actually happening under the surface rather than just a headline number.
Thanks, Zach. A lot going on in the world and in the markets and the economy. We're doing our best to keep our finger on the pulse of what's happening. And we try to bring you little snippets of that and what we discuss in the Allocation Week every week in these market carvers. If you have any questions or you'd like to schedule a meeting, please use the QR code on your screen or the phone number or the website URL that you see right now. We would love to be able to talk with you or have set up a meeting with one of our advisors. Thank you and have a great week.